My name is Lee Gehring, and I'm the eponymous managing director of the firm Gehring and Rosenzweig Associates. It's a firm established with my long-term colleague Adam Rosenzweig, who's here in the audience today, that is dedicated to researching and investing in global commodity markets. We've been avid followers and researchers of global commodity and natural resource markets for over 30 years. And during that time, we've made some pretty contrarian investment calls. Some of you may have heard me speak at the previous 121 mining conference held back in June of this year. At that conference, I spoke on global copper markets and how we believe copper had entered into a huge bull market that would play out in multiple stages in the next 5 to 10 years. No metal, we believe, has a more bullish supply-demand profile. Because of the Trump-led trade war fears, copper has pulled back significantly since when I presented 3 months ago. However, I think that the pullback here represents a tremendous buying opportunity in the copper market. But today, I'd like to talk about another metal, a metal that we believe has the potential to, and is potentially set up to become maybe the best performing asset class of the coming decade. But before I start, I'd like to tell you a little about myself, who we are, our research process, and how this all fits into our bullish price forecast for this metal. For those that don't know me, I've been managing various funds invested in global resource markets for almost 30 years. We are contrarian investors, and we believe the best time to find deep value, investment value, is when a commodity market is depressed, investors are extremely bearish, companies operating in the sector are often losing money, valuations are cheap, and our research tells us that the bear market in that commodity is over and a new bull market is about to begin. We love to get involved in commodity markets that are deeply depressed and where consensus opinion is universally bearish. The more a commodity market becomes depressed, the more we roll up our sleeves and the more research we do. And oftentimes our research comes with conclusions that are vastly different than market consensus. In the depths of bear markets, we attempt to spot data inflection and turning points far sooner than average investors and analysts, and we're not afraid to publish our non-consensus outlier views and our price targets. And that brings me up to what I would like to discuss today. I thought I would like to go over another bull market that we believe has the potential to become, as I mentioned before, potentially the biggest bull market of them all in the coming decade. Although this metal is mined, like most other metals, its unique characteristics have made it a commodity with multiple uses. Historically, its price has been fixed. However, since 1971, governments have allowed its price to float. And over the last 50 years, two spectacular investment opportunities have presented themselves in the metal. Many investors have claimed that investing in this metal has historically yielded poor returns. As opposed to investing in bonds and stocks, this metal, as we all know, earns no interest, nor does it partake in any business through the payout of dividends, and it costs money to store. This is all true, and we have never made the case. Excuse me, hold on 1 second. But this metal, we've never made the case that this metal should be held for long-term investment capability. And as most of you have guessed, I'm talking about the price of gold. However, we believe that gold is just like any other asset class. All asset classes, whether they be bonds, stocks, emerging markets, commodities, they become popular, sustain large price advances, and become overvalued. At that point, they represent poor investments. Conversely, these same asset classes will undergo long periods of investor disinterest, experience sustained and drawn-out price declines, and consequently will become undervalued. At that point, they often present investors with excellent investment opportunity. We agree with the consensus opinion regarding gold on a long-term basis. Gold represents a poor investment. We agree with Warren Buffett on that. As its critics point out, it pays no dividends, interest, as I mentioned, and it's expensive to store. However, if investors can properly identify those periods when it's severely undervalued, then gold can, as any other asset class can, produce superior and often spectacular uncorrelated returns, just like it did in 1929, 1970, and 1999. As many of you know, we believe that gold today is extremely undervalued, and that a huge bull market, which started back in 1999, is approaching another massive surge upward. I should point out that we are generally bullish on commodities in general. And I should point out that in all previous commodity bull markets, the gold bull market has simultaneously taken place as those commodity bull markets unfolded. In other words, there's never been a structural bull market in commodities that hasn't been at the same time experiencing a structural bull market in gold. The only question an investor faces today is whether the upcoming bull market in gold winds up matching the bull market in commodities like it did last decade, or does it spectacularly outperform the bull market in commodities like it did back in the 1970s? And that's going to be the topic of my talk today. As you can see from this chart, of which a copy of this appeared in Barron's 2 weeks ago, and I should point out something interesting about this chart. This is a chart that I used starting back in the late 1990s to talk about gold potential, and I had never seen gold valued this way. And in the interim, Pierre Lassonde of Franco-Nevada has decided to like the chart very, very much. It shows up on all the Franco-Nevada presentation materials, but it's actually my chart.
Lee?
Yeah.
Question?
Yeah.
I did read the article in Barron's 2 weeks ago, and I did see all the charts. But, I don't find this chart very helpful, and I'll tell you why. You don't have CAGR, compound annual growth rate, and that would make all the difference. I mean, looking at these percentages, it's misleading. It doesn't say over how many years. Some of them are 5 years, some are 30 years. It would be much more effective if you could actually see the compound annual growth rate.
The growth rates.
No, that's not a compound annual growth rate.
The point is not. Those growth rates versus they're what they are is versus financial assets. Just look at the difference. That's the point that the chart's trying to make, not the actual compounded rate of return on an annual basis. So there have been 3 periods, according to this chart, where gold has been radically undervalued compared to the stock market, and 2 periods where gold has been radically overvalued. As you can easily see, periods of radical undervaluation in gold happen during simultaneous periods of overvaluation in financial assets, particularly the stock market. With the stock market frenzy peaking in the late 1920s, investors should have sold all their stocks and put their money in gold. And we'll ignore the fact that the U.S. made gold ownership illegal post-1932. But even if you couldn't buy gold, however, an investor could have owned either home-stake mining here in the U.S. or dome-stake mines in Canada, both of which proceeded to advance over 500% between 1929 and 1936. As multiple crazes gripped the U.S. stock market in the late 1960s and early 1970s, a appreciative investor would have sold all their stocks and again put their money in gold. And finally, as the dot-com bubble gained full steam, wise investors would have again sold all their stocks and put all their money in gold. For those interested, the returns for stocks and bonds for all those periods I just described are listed on the bottom of the page. And I'm sorry I don't have them compounded annually. I could do them for you, but they'd probably be pretty darn good. However, what happened between 2000 and 2011, the 11-year period listed between points E and F on this chart, I think requires special comment. Between 2000 and 2011, gold had advanced over 7-fold, whereas the stock market, after suffering the dot-com implosion and then the 2008 Lehman financial crisis, had just managed to reach back to its 2000 peak level. At this point, with the stock market at 11,000 and with gold hitting a peak of 1,900 per ounces, the stock market was trading for a little under 6 times the price of gold. Although not anywhere near the 2 times level reached at the market bottom in 1932, or the 1 times price level reached back in January of 1990, gold had certainly lost some of its radical overvaluation relative to the cheapness reached back in 2000, when the Dow Jones Industrial Average was priced at almost 42 times the price of gold. After hitting 1,900 in August of 2000, gold has proceeded to pull back 45% in the next 5 years. And today it still trades 35% below its 2011 price peak. From a valuation of peak low reached in 2011, the Dow where Dow is being priced 6 times the price of gold, today gold is now back in undervalued territory. With the Dow at 26,000 and with gold at $1,200 per ounce, the Dow gold ratio now stands at almost 22. Although gold is not as radically undervalued as it was back in either 1970 or 2000, today its undervaluation level rivals that of 1929. However, some of you might be thinking, was the $1,900 peak in gold the bull market top in this cycle? Are we now in a cycle where gold now underperforms the stock market for the next 10 to 15 years, and the Dow gold ratio goes back to either the 1970 or 2000 high? It took 42 ounces of gold to buy the Dow back in 2000. Buying the Dow today with 42 ounces of gold implies a gold price falling to $625 an ounce. These are all valid observations, but I want to make 2 points that clearly I think indicate the gold bull market is far from over. In fact, I will make a bet right here today that in 10 years' time, we will look back at today's $1,200 gold price and say, what was I thinking? I should have put all my money in gold. I was given the most amazing buying opportunity and I missed it. The 2 points I want to make are, first, we have seen this type of price pullbacks in previous gold bull markets. As some in this audience will hopefully remember, gold was the best performing asset class in the 1970s. However, after surging from $35 per ounce in 1970 to almost $200 per ounce in 1975, gold proceeded to pull back almost 45% in price. In 1970, the Dow Jones Industrial Average was priced at almost 30 times the price of gold. However, by the first quarter of 1975, as gold was flirting with $200 per ounce, the Dow was priced at only 4 times the price of gold, slightly more expensive than the 6 times experienced back in the fall of 2011. However, was that the ending of the gold bull market? As we all know in retrospect, the answer was an unequivocal no. After pulling back 45%, gold bottomed at $105 per ounce in the summer of 1976, and then proceeded to rocket 8-fold in the next 3.5 years. After starting the decade with the Dow Jones gold ratio hitting 30, by January of 1980, the Dow Jones Industrial Average and the gold price literally crossed. The ratio of gold and the Dow hit 1-to-1 on January 21st of that year. Using the template of the 1970s gold bull market, you can make the case that it's not unprecedented for gold to lose some of its undervaluation versus the stock market. Back in 1975, the Dow gold ratio hit 4, and yet the most profitable part of the gold bull market was still in the not too distant future. And I'd like to make the same case today. However, there's something else at work today, which gives me great confidence that the 45% pullback that we have seen in the gold price since 2011 will be looked upon only as a correction and in retrospect a tremendous buying opportunity. Please look and carefully study this chart. Although we get a lot of pushback on this chart, I think it describes something really profound. And again, just like the Dow Jones Industrial chart that I used back in the late 1990s and no one used, I don't see anyone using this chart today. As I will elaborate in a second, this chart suggests that the gold bull market that we all believe starting back in 2000 probably really hasn't even begun yet. What is this chart? This chart just shows the dollar value of the Federal Reserve's monetary base versus the dollar value of the U.S. Treasury's gold holdings. As you can see, there have been 2 times in the last 100 years where gold has been radically overvalued. With Roosevelt having raised the gold price to $1935 per ounce in 1934, and with war coming to Europe, gold flooded into the U.S. Treasury to the point where by 1938, the dollar value of gold held by the Treasury exceeded the dollar value of the Fed's monetary base by almost 1.7 times. This is incredible when you think about it. The UK used to run the pound on a gold standard with a ratio of gold to currency that averaged about 35% coverage. And yet here in the US, the US Treasury could have distributed physical gold to every holder of a dollar bill and still have 70% of its gold left. That's how scared the world was back in 1938. Between deflation, depression, and the coming war, investors were all clamoring for gold as the safest asset to hold. And yet, was this the smart thing to do? As you would expect, the most popular asset class did miserably over the next 35 years. Gold returned absolutely nothing. And the stock market, which represented the asset class that absolutely no one wanted and no one owned, proceeded to surge almost tenfold in price. The other period of radical overvaluation occurred again in 1980. In a strange replay of the 1930s, the dollar value of the gold still held by the Treasury again surpassed the dollar value of the Fed's monetary base by almost 1.7 times. The same level of overvaluation experienced back in 1938. In the 1930s, gold's overvaluation was driven by fear, deflation, depression, and war. In the 1970s, gold's overvaluation was driven by surging inflationary expectations. In another replay of the 1930s, gold, the asset that you had to own in 1980, proceeded to fall by 65% in price in the next 20 years. In comparison, the asset classes that no one wanted, that is, stocks and bonds, entered into a 35-year bull market that is still ongoing today as I speak. In comparison to the periods of gold's overvaluation in the late 1930s and 1980, there have been two easily recognizable periods where gold was radically undervalued. Because of the Vietnam War and President Johnson's Great Society spending, the 1960s saw huge periods of excess credit creation and large increases in the Fed's monetary base. There were large outflows of gold outside of the U.S. Treasury, because remember that gold was still convertible to foreign central banks at $35 per ounce. Because of the large expansion of the Federal Reserve monetary base, and because of the government was still pegging the gold price at $35 an ounce, by the late 1960s, the ratio I just described had done a complete flip. In the late 1930s, the dollar value of the U.S. gold holdings exceeded the monetary base by 1.7 times. By 1970, the dollar value of the Federal Reserve's monetary base had grown to exceed the dollar value of the Treasury's gold holdings by almost 7 times. In other words, the world was awash in money. In retrospect, we know that the dollar value of gold was now in radically undervalued territory. The U.S. Treasury is forced to suspend dollar convertibility to gold in 1971, and gold proceeded to skyrocket in price. The other period of radical gold price undervaluation occurred back in the late 1990s. Under Alan Greenspan, the Fed, in response to multiple financial crises, had spent a decade printing too much money, and by 1999, we had come full circle. By 1999, with the Fed's monetary base reaching almost $600 billion, and with gold falling to almost $250 per ounce, the Fed's balance sheet now exceeded the Treasury's gold holdings by almost 10 times, slightly exceeding the levels experienced back in 1970. Again, the world was awash in money. Given that the dollar value of gold had become cheap relative to the quantity of dollars printed, we would have expected a huge gold bull market to emerge in the next several years, and that's exactly what we got. But this is where it really gets interesting. Preceding every bull market in gold has been a period of excess monetary creation. In response to the British pound being placed back on the gold standard at an overvalued rate, the Fed, under Benjamin Strong, printed huge amounts of money in the late 1920s. As mentioned before, both the 1960s and the 1990s saw both sustained periods of excess monetary creation. And all three periods also saw intensive periods of speculation in the stock market, most likely brought about by this excess monetary creation. And that's what intrigues me so much today. Since 2009, the Federal Reserve has embarked on 3 periods of quantitative easing, which has now been emulated by both the Bank of Japan and the European Central Bank. Since 2008, the Fed's balance sheet has exploded, and now its monetary base stands now over 4 times bigger than it did before the 2008 financial crisis began. Even though the gold price is up 5-fold from its 1999 bear market low, the ratio of the Fed's monetary base to the Treasury's gold holdings now significantly exceeds the levels seen back in the late 1960s and the late 1990s. As I mentioned before, back in 1969, the Fed's monetary base exceeded the value of the Treasury's gold holding by 7 times. In 1999, the Fed's monetary base exceeded the Treasury gold holding by almost 9 times. Today, with the Fed's monetary base sitting at $3.6 trillion, with gold priced at $1,200 an ounce, the Fed's monetary base exceeds the Treasury gold holding by 11 times, the highest level ever. Every gold bull market in the last 100 years has been preceded also by excess monetary creation and related historical speculation. And today we have just lived through one of the most intensive periods of monetary creation ever. And we've also had multiple periods of associated speculations, whether it be cryptocurrencies, the FANG stocks, or the first signs of speculation we're now beginning to experience in the cannabis-related stocks. What happened in the late 1920s and the late 60s and the late 90s is any guide between all the excess credit creation and the related periods of financial speculation. We are set up for a huge bull market in precious metals of historic proportions. As we wrote in our last quarter letter, we still believe the correction that we're experiencing in the current bull market in gold prices that started in 2011 isn't quite over yet. However, given the intense level of monetary creation undertaken by central banks in the last 9 years, and given how cheap gold is being priced relative to all this money, we have great confidence that the pullback in gold experienced since 2011 is a pullback in a massive bull market that started nearly 18 years ago. How high might the gold price go in the next bull market? I don't have enough time today to go into various valuation methodologies that we use to value gold. But let's just go back to the historical relationship that existed between the Fed's monetary base and the dollar value of the Treasury's gold holdings. Back in 2000, I was profiled in Forbes magazine, and here's that article, and I predicted a huge bull market in gold. As you can see from the headlines, I was brash enough to actually state a price target, and I was widely laughed at for making such an outlandish prediction. This Forbes issue came out in June of 2000, and gold was priced at $275 per ounce. Given gold's unpopularity at the time, and I hope some of you remember what that period was like, even suggesting that gold could go that high seemed an simply outlandish prediction. Although we didn't hit my $2,500 prediction, at $1,900 per ounce, we actually came pretty close. And how did I come up with that $2,500 price target 18 years ago? 2,500 was just the Fed's monetary base in 2000, multiplied by 1.2 times. I was being conservative, I didn't use 1.7, divided by the 262 ounces held by the US Treasury. Today's monetary base, and let's take out all those excess reserves that have been the result of quantitative easing, and let's assume that they are ultimately all drained away as the Fed shrinks its balance sheet, which is now trying to do. Today, the Fed's monetary base stands at 3.6 trillion. Excess reserves are 1.9 trillion. So the adjusted monetary base, we calculate, stands at 1.7 trillion. Remember that back in the late 1930s and 1980, the dollar size of the Treasury's gold holdings exceeded the size of the Fed's monetary base by greater than 1.5 times. If that were to happen again, the gold price would reach somewhere between $10,000 to $12,000 per ounce. And that's basically my price target in the upcoming bull market. And remember that $2,500 price target that I placed in the public domain through that Forbes article in 2000, when gold was trading at $275 per ounce, sounded absolutely implausible, but we almost got to that price. For those that are interested in other valuation scenarios for gold prices, please consult our last letter, which is published on our website, GehringandRosenzweig.com. And there I go into the other valuation scenarios that we use. They all point to much, much higher prices. Many of these valuation scenarios that are outlined in our last letter, again, seem highly implausible. But please remember that these valuation levels have emerged not once, but twice in the last 100 years. And it's my firm belief, given all the monetary and related credit problems that we have out there today, for example, the huge explosion of debt outstanding combined with all the turmoil in global central banking, all being shown up like things like quantitative easing, that is, all that turmoil has again caused these types of valuation ratios to be experienced again. The stage has been set for a huge bull market on the next leg up. And my price target for the next leg is a minimum of $10,000 per ounce. So with that, I guess I can open it up for any questions you might have.
How many ounces of gold did you say the U.S. is holding right now?
262 million ounces.
You said individuals should keep perhaps 5%. You said an individual conservative should invest maybe 5% of their assets in gold as sort of a protection and a possibility of commodity improvement.
Right. I think, given the fact that gold is radically undervalued today, as it was back in 1970, in 1999, 2000, I would say that more than 5%, I would say somewhere between 10 to 15%. Remember, gold and the price behavior of financial assets have historically been uncorrelated and actually inversely correlated. And it's logical that we're seeing a huge period of speculation taking place in financial assets today. And so I think that in itself is another indication that more than 5% of your net worth should be in gold.
And this bull market of the equity, most of the money goes to tech stock and also the private equity. So, and add to that, actually, I think it will be a better representation than just the Dow Jones. Because the Dow Jones, most of people these days invest in tech stock
Yes.
and the private equity
Yes.
rather than this bull market, I mean, rather than just the Dow Jones. So I think that would be a better representation.
Oh
than
yes,
Dow
you could,
Jones.
you could definitely do that. I don't think it really matters what indices you were to use. I mean, how
That would show a much dramatic.
it would be much more dramatic,
Yeah.
yes. But that would only make my case even stronger.
Yeah, that's
You mentioned earlier that you think that long-term holdings of either gold or silver is not a good play, but it's more kind of a timing issue. So would you, is it your thought that it makes more sense to invest in the hard asset or into proxies such as a gold ETF or gold stock?
I think the gold ETFs are fine and are certainly I think serve a very useful investment purpose. And I don't fall into the conspiracy camp that the GLD doesn't have the physical gold and things like that. I think that they're absolutely fine. As you know, I mean, if any of you have experiences investing serious quantities of money in gold, and even more with silver, it's a very difficult thing to do. It's a very difficult thing to do. And I mean, just, trying to, make an arrangement to have a gold shipment done at your bank where you have a safe deposit box is an interesting experience. Besides the fact that the bank probably doesn't want to cooperate with the fact that you're going to bring guys in with guns and bags of gold to put in the box. So, that's, for those people who don't want to do that, the GLD is fine. Now the question, an interesting question, do you go with gold stocks or with gold itself? That's a whole different question. That'll be my next 1-to-1 mining conference speech.
The ratio with gold versus copper would probably work as well. Like, what's your copper forecast? You said you're pretty bullish there.
Yeah. In fact, I believe at the last 1-to-1 mining conference, I put forth a copper price forecast between $7.50 and $10. And I know that sounds outlandish, but in that thing, I remember I was profiled again in the Barron's commodity column back in 2000, pretty much the same time that this came out. And I said I'd undergone a conversion from a structural copper bear to a structural copper bull. And at that point, I believe that copper was like 68 cents. And I remind people, look, what you went from 68 cents, you went to $1.50, which basically been the highest price that copper had ever sustained before. And basically in the cycle, you went to $4.60. Like using the same valuation multiples, and given the demand supply trends in the copper market today, I think you could easily see a $7 to $10 price. Again, it seems outlandish, but if you said 2000 with copper 68 cents, I'm bullish. I think it's going to hit $4.60. Everyone would say you're crazy. And remember, there was a huge sum of money lost in 2006 by speculators, hedge funds who thought that $1.50 would never be exceeded.
Any further questions?
Okay, well, thank you very much, everyone.
Thanks very much.